Rates are up and you're wondering if you can still make positive cash flow. However, in commercial property, even with the interest rate going up, you can still make positive cash flow today now in a commercial property investment. How are we going to do that? What are the figures? I'm going to break it down for you in this video, and I'm going to show you where you can buy that you can still be making money and still get the security that you need, plus around a 5% capital growth as well. So having the best of both worlds. My name is Helen. I've been helping everyday Australian become wealthy through investing in commercial property, and I want to do the same for you. If you're interested in moving forward in any of our scenarios, learning about commercial property investing, simply joining one of my webinars, or just finding out more, there's a link below where you can book in for a strategy call, and it's absolutely free, or join us at one of our upcoming webinars as well. So make sure you check out that link. You've got a pile of money. Well, let's say you've got some equity, and all of a sudden you're thinking, I want to invest in a positive cash flow property. Now, interest rate goes up. It means that if you were on 5% or 5.5% in your residential mortgage, what you're now facing is potentially paying 5.75% or even 6%. So that means that all of a sudden, if you're trying to draw out $200,000 or $300,000, you have a shortfall somewhere between $25,000 to $30,000 that you're going to have to find to be able to pay for and be able to support that deposit. And all of a sudden, if you're going to go and buy $1 million property, you are going to be negative. So what do you do? How do you move forward? Because let's face it, the name of the game is the more you accumulate, the more you buy. Ultimately, that compounding of continuous rental growth and the compounding of cash flow plus growth gives you wealth and means you can retire sooner if you actually have a portfolio that's not relying on you. Luckily, in the commercial space, commercial property investing, buying commercial property is not reliant on you. You don't need you to service the loan. You don't need you to manage all of the headaches of maintaining the property. It doesn't need you to pay all the outgoings. Yes, you heard it right. The tenant pay all of the outgoings in commercial. And yes, that is land tax, that is management fee, that's insurance, strata, whatever you can think of in terms of the outgoings of the property, the tenant pays for it. And you're wondering how, why, don't we have legislation? Like, yes, we do, but everything commercial property trades on the net yield. Whatever the rent the tenant's paying, we make sure that every single outgoing has been taken out. Some tenants pay everything except for management fees, and we just take out the management from the rent that they pay to get to a net figure, because everything has to be at a net figure. Then we work out what exactly is the purchase price. Now, that might seem confusing, but if you just join one of our webinars or come to a strategy session, we'll be able to explain to you in more detail, but I'll also explain to you on this video. So let's say you're buying $1 million property. Now, obviously, if you're buying a residential property, you're going to be borrowing from the equity of a previous residential property or maybe your home. So you're going to be refinancing that, pulling out the equity, and the equity has a value that has an interest rate attached to it at about somewhere between 5 to 6%. So you're going to have to come up between anywhere from $20,000 to $30,000, depending on how high your interest rate, to support that. Now, couple that with another loan, and then you need to pay the interest on that loan. So the two added together, and if you're buying residential, you have to add the outgoings, makes the property very, very negative. So if you're buying $1 million property in residential, you're probably negative somewhere around $15,000 to maybe potentially even $20,000. Now, the same property in commercial, and we're talking about relatively the same places that you would buy your residential property. So same, but a little bit different, right? So what does that mean? If you buy a residential property in Sydney, you can buy a commercial property in Sydney as well. You buy residential property in Melbourne, you can buy a commercial property in Melbourne, and so on and so forth. So Brisbane, a city, wherever you want to buy a residential, you can buy that same one in commercial around the same price point. So let's say you want to buy something in Sydney for $1 million, you get about a 1-bedroom plus a study. In commercial, you get a little shop front. And that shop front probably gives you somewhere about a 5% in terms of net yield. So it gives you $50,000 in rent. Now, will you break even on $50,000? You're borrowing 100%, which means equity is drawn down from offset or from another property plus your commercial loan. No, you're going to be negative. So buying in Sydney is not a good idea. However, if you go and buy in Melbourne, $1 million will allow you to buy a house. The house rent will probably give you about $40,000 or $50,000 in gross rent, which means you have to take outgoings plus your mortgage, both the equity, so the deposit as well as the loan. You're going to be negative about 15 to 20 grand. If you're buying a commercial property in Melbourne, you're about 6% yield, which means that you're actually going to break even. I want to make cash flow. How do I do that? Well, you simply go a little bit further out. So we can go to somewhere like a Warrnambool. You go somewhere like a Toowoomba if you're in Brisbane. In Sydney, you probably go further out into areas like Maitland or Singleton. If you are wanting to go more regional, you can go into an Albury-Wodonga, you can go into a Bundaberg, a Townsville, you can go into Cairns. Those properties are going to yield 6.5% to 7%. In commercial, it's all net yield. So let's break the numbers down. Let's say you're buying $1 million property, you're going to borrow 100%. How do you borrow 100%? 30% of it is going to be coming from the drawdown or refinance of your other investments. So whether that's an investment property, whether that is your principal home, you're going to draw out $300K. Now that has a price. Usually right now the interest rate probably 5.5%, but let's assume 6%. Then you're going to borrow 70% on a lease stock loan in commercial. So lease stock loans in commercial is not dependent on you, dependent on the lease term to give you the loan. So it's not dependent on you at all. So they're not going to test you for servicing or anything. They can give you the loan. So that loan is roughly about 6% interest rate right now. If I assumed a 6% interest rate on the whole $1 million, which is the price of the property, 30% comes from your residential property, the equity. Let's assume the 6%, which is fairly high, so we're leaving a buffer in place. And then the 6% on the 70%, it's $60,000 to service $1 million property in interest. Now, if you go out and simply find a property at $65,000 in net rent or $70,000 in net rent, you make between $5,000 to $10,000 per year in positive cash flow. Now you might think, okay, well, that's not a huge amount. It's not going to break the bank and it's not going to, get me to financial freedom. No, it's not, but it's a starting point because firstly, the property is not dependent on you. Secondly, all the outgoings are taken care of. Thirdly, it's already putting money in your pockets. Each year, it will compound by another $2,000 or $3,000. It depends on rental increases. Plus, you have capital growth as well. So you're not eroding your money, you're actually making more money. So that property somewhere in the regional areas will probably make about 5% in terms of capital growth. So it makes about $50,000 in capital growth. So you get about $5,000 to $10,000 in positive cash flow after all expenses being paid and mortgage and everything else. Then you get about $50,000 in capital growth. So it's actually the best of both worlds. If you could continue to do that and you can add some more equity in there in the future, it becomes a really good foundation for you to get a more positive cash flow portfolio, especially if you are negative in your residential side of the portfolio. The other thing to think about that why you want to get started is ultimately the rates are not coming down anytime soon. It might hold at this level. It might go up a little bit. It might even come down in 12 or so months. But whatever the verdict is, a lot of people have stopped buying. And the most detrimental thing to your portfolio is stop buying. However, if you bought a property that was positive cash flow and not dependent on you on a servicing, means you can continue to buy. And that's why commercial property becomes so important now in terms of the investment strategy moving forward. Let me just recap this. Why, even with the interest rate going up, you can still get positive cash flow from commercial property. It's because it's traded on net yield. All outgoings have been taken out. It's a net return. You can still go to regional areas or fringe areas and get 6.5% to 7% in terms of a net return, which means after mortgage, after outgoings, you're still making positive cash flow, real tangible positive cash flow. If you want to do more and you're happy to go to mining towns or something that has a little bit more risk, you could even get to 8 to 9%, which means that even with the interest rate at 6% overall and 100% borrowing, allowing, of course, you putting in money cash for stamp duty, or if you buy an ACT, there's no stamp duty. Allow for all of that. You can, if you're buying an 8 or 9% property, you could be making $20,000 to $30,000 on one property, but that of course depends on your risk profile. This is all commercial property is different from residential, is it's individual and property specific versus a generalization. So commercial property, they're going to say been going up by 5% in the last 10 years. That's not commercial property. Commercial property goes, well, in the last 3 years, this area has done X, Y, Z, the rents have gone up X, Y, Z, and this, therefore, the capital growth. Unlike in residential, we talk more blanket. So commercial is all about niching down and building individual strategies. So that's what we want to do here for you at Unicorn. My name is Helen Tarrant. I've been helping everyday Australians create wealth through commercial property investment, and I want to do the same for you. So click the link below if you're interested in joining a free webinar, or if you're interested in booking a free strategy session to find out more if commercial property is right for you. No obligation, just find out more. And if you love this video and you want more around commercial property, just simply leave a comment. Let me know what type of videos you want me to make. Hit the subscribe and the bell, and just pass this video on so someone who's a beginner can see how they can make positive cash flow through commercial property. Thank you, and I'll see you in the next video. Bye for now.